good morning Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at one of the largest banking franchises in the region, NCB Financial Group, or NCBFG, as well as its majority-owned subsidiary, Guardian Holdings Limited, or GHL. Now, both groups would have put forward a very commendable performance in the first half of the calendar 2022, or in the case of NCBFG, the first 9 months of its fiscal year. Let's take a look at how both of those companies performed and what investors can expect in the coming months. Now, turning quickly to NCBFG, and the group reported a TT dollar equivalent earnings per share of 36 cents, a whopping 94% increase from the 19 cents recorded in the prior comparable period. This was really driven by an increase in net result from banking and investment activities, up 8.7% from 3.28 billion TT equivalent to just over 3.56 billion TT equivalent. And net operating income overall increased around 15% from 4.08 billion TT to just about 4.7 billion TT. Operating expenses increased just marginally, about 8%, from 3.18 to 3.4 billion, and profits attributable to equity holders increased a whopping 88% from 440 million TT equivalent to 830 million TT equivalent odd over the comparable periods. Now, when we take a look at net operating by segment, or net operating income by segment, an overall 15% increase, there were some major changes across all segments, with most segments reported in double-digit increases, with the exception of one, that is gain on investment activities in that purple segment, which actually fell from 547 million to 313 million TT equivalent, or a 42% decline. This was, however, offset by double-digit increases in other business segments, particularly net interest income, which increased 17% from 1.8 billion to 2.16 billion TT equivalent. Net fee and commission income also up around 14% from 750 million to 852 million. And net result from insurance activities up a considerable 40% from 805 to 1.134 billion TT equivalent. So certainly NCBFG heading in the right direction in terms of increases or recovery in earnings. And when we take a look at what that has done from an investor perspective in terms of valuation, well, that combination, combined with a decrease in NCBFG's price year to date, which is actually down around 37%, has returned NCBFG to pre-COVID levels in terms of valuations and a PE ratio, with that price earnings ratio coming down to a more palatable 11.5 times odd for investors, compared to a whopping 30.5 times, which meant the stock was very expensive as at the 9-month period of 2021. And that decline in price, combined with the resurgence in earnings, has really led to that improved valuation. And as we can see on a trailing basis, the earnings per share figure is just around 44 cents per share TT equivalent, which again takes it back to its historical pre-COVID range of around 45 to 50 cents TT dollar equivalent. So at the price of $5.05, NCBFG is, as mentioned, trading at 11.4 times price to earnings ratio, which is below the sector average of around 14.9 times. The company, or the group rather, opted not to declare a dividend under the current circumstances, and that has resulted in its dividend yield being just about 0% compared to the banking sector average of 3.2%. But on the basis of improved profitability, cognizant of continued financial market volatility, which could weigh on earnings in subsequent periods, and with those fairer valuations in mind, Bourse is going to maintain a market weight rating on NCBFG for the time being. Turning quickly to Guardian Holdings Limited, or GHL, for the half-year or 6-month period ended 2022. Earnings per share was up 70.9% to $1.88 compared to the prior comparable period of $1.10. Net income from insurance activities buoying earnings overall, up 63% from 417 million to just about 680 million. Net income from all activities, however, much more measured, 5.4% increase from 1.25 billion to 1.32 billion. Operating expenses actually declined for the group, and overall profit attributable to equity holders increased at 70.1% from 256 million to 435 million. When we take a look at net income by activity action for GHL, we can see that net income from insurance activities in that lime green color increased from 417 to 681 million, that 63% increase, which more than offset a decline in income or net income rather from investing activities, which fell 25% from 770 million to just around 570 million, with some modest increases in the smallest segment by activity for net income, that is net income from brokerage activities. And in similar vein to NCBFG, the price decline for Guardian Holdings, although a smaller 15% decline year to date, combined with that recovery or continued growth rather in earnings, has led to a moderation in the price earnings ratio for Guardian Holdings, certainly much more attractive compared to the non-banking finance sector multiple average at 6.2 times, and that trailing earnings per share figure at $4.15. So at that price of $25.52, Guardian is trading, or GHL is trading rather, at a 6.2 times earnings multiple compared to the sector average of 21.8 times. So it does appear on a price earnings ratio basis to be much more attractive than the sector on average. But that dividend yield is notably below the dividend yield of the sector at 2.8% compared to the sector average of 4%. So with those improving earnings in mind, but again, with cognizant of financial market volatility and that below average dividend yield, Bourse is going to maintain market weight rating on Guardian Holdings for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse, email us at invest@boursefinancial.com, and you can access all of our research absolutely free at www.bourseinvestment.com. That's it for this week's edition of the Bourse Report. Stay safe, and we'll see you next time on the Bourse Report.